Welcome back to episode 8 of Truss Talk. I'm Jason Nichols, and today we are tackling a heavy topic. It's the elephant in the room whenever we sit down with couples to discuss their retirement.
I'm Jeff Miller, CEO at Truss Financial Group. In my 30 years of doing this, I've found that the biggest fear isn't about interest rates or closing costs. It's a very human fear. It's the husband or wife looking at me and asking, if I pass away tomorrow, is the bank going to kick my spouse out of this house?
It's a terrifying thought. You've spent 40 years building a life, raising kids, and making memories in a home. The last thing you want to leave behind is a legal nightmare for the person you love most.
There are so many horror stories from 15 or 20 years ago about the widow trap. And today, we're going to set the record straight. We're going to talk about the massive protections in place in 2026 that ensure your spouse stays protected, stayed housed, and stayed in control.
Let's start with the basics, Jeff. If both spouses are on the reverse mortgage, what happens when one passes away?
That's the simplest scenario. Nothing changes. The surviving spouse just keeps living there. The loan doesn't become due, the payments, or lack thereof, stay the same, and the home ATM line of credit stays open. It is a seamless transition.
But let's get into the scary part. What if only one spouse was on the loan? Maybe one was younger than the age requirement when the loan was started. That's where the old widow trap lived.
Exactly. In the old days, that was a disaster. But in 2026, we have what are called non-borrowing spouse, NBS, protections. Even if your spouse isn't technically on the loan, as long as they were married to you when the loan closed and they meet a few simple requirements, they have a legal right to stay in that home for the rest of their life.
This is the game changer. Even if your spouse isn't technically on the loan, as long as they were married to you when you took out the mortgage and they meet a few simple requirements, they have a legal right to stay in that home for the rest of their life.
The bank cannot evict them. The loan doesn't call due. As long as that surviving spouse continues to pay the property taxes and the insurance, they are safe. They can stay in the neighborhood they love, surrounded by the neighbors they know. But I always tell people this protection isn't set it and forget it. To keep that right to stay in the house, the surviving spouse just has to follow 3 simple rules.
Right, you don't have a mortgage payment anymore, but you still have 3 bosses. You have to pay your property taxes, keep your homeowner's insurance active, and keep the home maintained.
As long as you keep the grass cut and the taxes paid, the bank stays out of your life. It's that simple. We make sure our clients understand that no payment doesn't mean no responsibility.
Now, Jeff, the second question we always get is about the kids. People worry that the bank just takes the house the moment the second spouse passes away.
Again, total myth. The bank doesn't want your house. They aren't in the moving business.
When the last borrower passes away, the home goes to the heirs just like a normal house. The kids have choices. They can sell the house, pay off the loan, and keep the remaining equity. Or if they want to keep the home in the family, they can refinance the loan into their own names.
And here's the trust secret that gives people so much peace of mind. These are non-recourse loans.
Yep, that's a big term, but it has a beautiful meaning for your family. It means if the housing market crashes and you owe $1.2 million on a house that's only worth $1 million, the bank cannot go after your kids for that extra $200,000. They can't touch your kids' bank accounts or their own homes. The house is the only thing on the line.
It's a safety net for your legacy. Your kids get the upside if there's equity, but they are protected from the downside if the market fails.
And Jeff, let's talk about the timeline. People think the bank shows up with a moving truck the week of the funeral.
Not even close. The family actually gets breathing room. Usually the heirs have 6 months to decide what they want to do with the house. And if they need more time to get things in order, they can often request extensions for up to a full year.
And just to be clear for everyone listening, that's a federal guideline. In 2026, the bank has to give you that time. They can't rush the process just because they want the house off their books. You are legally protected to take that breath.
That's a huge relief for a grieving family. You aren't making massive financial decisions while you're in the middle of a crisis. You have the time to talk as a family and decide, do we sell it or do we keep grandma's house?
At the end of the day, a reverse mortgage in 2026 isn't just a financial tool. It's a certainty tool.
It's about knowing that no matter what happens to you, the person you love isn't going to be forced to move during the most difficult time of their life.
But you have to set it up correctly. You have to work with experts who know how to navigate the non-borrowing spouse rules and the 2026 HUD regulations.
Don't leave your partner's future to chance. At Truss Financial Group, we don't just run the numbers. We help you build a plan that protects the people you care about most.
If you have questions about how a reverse mortgage would impact your spouse or your kids, give us a call. We'll sit down, we'll look at your specific situation, and we'll give you the honest truth.
Protect your home, Protect your spouse, build the bridge to a stress-free retirement.
Thanks for joining us for Truss Talk.
We'll see you next week.